Welcome to Capital Call, Boyden's podcast series of conversations with private equity and venture capital firms from around the world. Today, Boyden France Managing Partner Anita Pouplard speaks with Vladimir Lasocki, Managing Director and Partner at the Carlyle Group.
Good morning, Vladimir, and thank you for being with us today. I'm very pleased to welcome you as a guest to our Capital Call podcast series. You are Managing Director and Co-Head of Carlyle Technology in Europe. Before I ask you a few questions, would you like to give us a quick overview of Carlyle and your role in Europe?
All right. So most people know Carlyle for being a multi-fund, large corporate buyout and private equity shop. We, Michael and Juan and myself, manage a dedicated technology fund focused on the European market. We've been doing that for 20 years. Our fund today is a 1.35 billion euro fund. And we mostly invest in TMT businesses across the entire spectrum of TMT, services, software, hardware, in Europe, in small and mid-sized companies with a value of between 50 and 500 million euros.
Thank you very much. So let's start with the questions. Looking at your portfolio companies and how they have dealt with the pandemic, what are the factors that have made some perform better than others, according to you?
Right. So first of all, facts. 12 of our 13 portfolio companies had higher revenues and profits in the first 9 months of 2020 compared to the first 9 months of 2019. So the first statement I would make is that overall our portfolio has performed strongly. So our regret is that it would have done even better had it not been for the pandemic, but we cannot say that we have properly suffered from the pandemic. Why is that? I think essentially it's because we invest in B2B technology, media, and telecoms businesses. So if you look at it from a supply point of view, they mostly sell intangibles, software or services, which can be delivered remotely, that don't necessitate logistics or physical presence. I think also we mostly invest in primary deals where we partner with founders. So we typically have very agile management teams that are able to respond very quickly and mobilize teams around them to adapt. And that has been demonstrated across the entire portfolio. If you look at the demand side for our portfolio companies, as I said, they are selling to B2B clients, mostly services or software, which have become more important to our clients as the digital transformation has accelerated through the pandemic. And lastly, we tend to invest in businesses that are international, global, and have a very diversified base of customers. So those that have been more exposed maybe initially to China and then maybe to Italy or France always had another market to look at for expansion and development when their initial markets were being more affected by the pandemic.
Talking about management teams, as a global executive search firm, we can see that for many businesses, the pandemic has affected the approach to hiring at executive levels. Which skills and competencies do you think are critical now for a CEO and his leadership team in private equity-backed companies? Do you see any differences and what has changed according to you?
All right. So first, what I would say is we've been as active, if not more active as before, in terms of changing, adding to our management teams during the pandemic. So as a process, recruitment and HR matters have become equally important, if not more important than before, but certainly very active. In terms of the CEO himself or herself, I think if there's one skill that has become more important or more visible, it's communication and culture management, or the ability to carry and deploy a culture in the organization. Largely because every employee ended up being on their own at home, and all of the intermediate levels of management, all of the teamwork, all of the camaraderie that you have in the office had to be effectively replaced by one voice across the screen, which very often was that of the CEO. And not to say that for us at Carlyle, it's something that wasn't present on our mind, but it became very, very visible to everyone. And in this respect, we used to have Lou Gerstner as a chairman at Carlyle, and every year Lou would give a speech, and his speech was about culture. And he would say really two things. He would say culture is not part of the game, culture is the game. And then he would go on and discuss what culture meant. And his definition of culture is what people do when the CEO is not there, how people behave when their boss and their manager isn't there. And if you have a very strong culture in an organization where people understand what the purpose is, understand the importance of being transparent, of communicating, of exchanging, of helping each other out, you can withstand a crisis like the one we've had better. And if any place illustrated that, I would say that Carlyle, as a firm itself, has responded very strongly to the pandemic because of our culture. We've had weekly partners calls with every partner in the world. We've done deals across funds. We've put the companies in the hand of colleagues in the firm to get support across all sorts of issues, be it IT, be it HR, be it supply, be it external growth. And all of that was because our culture was at work, not because of a kind of vertical management style. So when it comes to CEOs, I would stress communication and culture management. If your question was about the rest of the teams and the executive suite, I guess as well. Well, like everyone would say, I guess, HR and IT or digital, not the HR manager, but the chief people officer, as we say today, not the IT manager, but the digital tsar, as we would say. Both have become clearly go-to people for everyone in the organization. So there is not an employee, there is not a manager in any organization today who doesn't know the first name of their CIO and the first name of their HR manager today, because we've all had to go to them on a daily basis for doing our work. So they've become much more in focus, and their role has become a lot more important in our portfolio companies. And I would say the same is true at Carlyle.
It's really interesting what you're saying, because in the past, for some companies, especially mid-sized PE-backed companies, the HR function was not so well recognized. Based on what you just said, would you see some differences in your portfolio companies, and would there be other functions that HR that have changed and gained in importance with this COVID?
So totally true on HR, totally true. We would hold town hall meetings with every employee of our portfolio companies on Zoom. We would ask employees if they had questions. The only questions they had were HR questions. Mm-hmm. Some of them very prosaic, some of them actually much more strategic. And HR has become also a key contributor to how we thought of managing the P&L. So clearly HR is one, and as I said, CIOs or digital transformation management teams have become much more in focus because we had to deploy tools in the near term, and because everyone became conscious that for the continuous delivery of our products and services in the portfolio companies, we would need to fast forward our digital transformation by some 5 years or so.
Indeed, as you said, that we have seen that this crisis has accelerated the digital transformation of many companies. What does it mean in terms of opportunities and threat in a firm like yours, knowing that you are dedicated to the tech industry? So your clients or your portfolio companies are already in tech. What would be your comments on this phenomena of digital transformation, generally speaking?
Well, it has some positive, some negative consequences. One of the negative consequences is every private equity fund is now looking at making investments in technology. So the demand for assets is going up. One of the positives is we own assets, and so we get potentially better terms when we are going to take them to market to sell them. But there's more competition for deals. There's no question about that. The second issue I would mention is it becomes slightly more difficult to distinguish between the long-term potential of a company and the near-term benefit they may have enjoyed because of COVID. A lot of the companies we look at, I would say, are late cycle businesses. So they, still performed quite well during COVID because they were working on projects that were already launched, or because they have recurring revenues for many. How much capital would be available for investment at our portfolio companies' customers in the next 2 years? It will remain to be seen. And some companies have had serendipity effects in the period that we've just experienced that may not be long-lasting. So to distinguish between the long-lasting trends and the near-term benefit that digital businesses have experienced is not easy as we speak. And in the context of high valuations, the price of making mistakes is higher.
And in the context of new investments and in lockdown, that most of the European countries are today under lockdown, how has pandemic changed your access to new investment and to the way you are going to do due diligence? What do you do, and how can you still continue doing your work?
Okay, good question. I'd say we would have given a different answer 6 months ago to the one I would give today. 6 months ago, we were very concerned. When we look at what we've done in the last 6 months in our fund, and more broadly at Carlyle as well, but in our fund, we've never invested as much as we have in the last 6 months. We bought 5 new platforms. We bought 5 new platforms in the fund. And why is that, and how did we do that? The first thing I would say is, with the pandemic, you don't work less, you actually work more. People have more time to work. People are more efficient with the use of technology and less time being wasted on transport and meeting. Second, you have a constraint, so you focus more. You have to chase fewer deals because you cannot spread yourself across many situations given your constraints. And because you cannot visit sites and do meetings and you fear that competition might get faster at a particular opportunity then you tend to focus a lot more. And why is it that it has helped us? Well, I would mention 2 things. First, in a context like this one where you have to focus more and it's harder to shake trees and get deals through because you cannot travel and meet as many people as you wish, there's a strong benefit to being focused and to being sector specialist. The deals we've done are investments we've made in companies that we already knew, in sectors that we already knew, because we only focus on B2B technology businesses in Europe. And we've been doing that for 20 years. So we know the companies in the sector. We know the markets. They may or may not be for sale at any point in time, but we have a view on them. And when we can get to them and when they are interested in doing a deal, the diligence becomes easier as a result of us being already knowledgeable about the management teams, what the businesses do, and the markets they serve. The second aspect is we tend to focus on relatively more complex deals where effectively the transaction is a way of unlocking value, be it a corporate carve-out, be it a tech private, be it a partnership with a founder in a deal which is still family owned. And in those deals that are slightly more complex, you need to bring more resources to bear, maybe sector specialism, maybe presence in a different geography, maybe particular skill sets when it comes to execution, if it's a tech private, for instance. And when you're a firm like Carlyle and you have a lot more resources in-house, it's easier to tackle those complex deals when you have a constrained environment. So if you look at what we've done in the last 6 months, we took a business private in France, a lot of support from our colleagues in the Paris office from an execution standpoint. We invested in a company called Calastone in the UK. We brought in our financial services fund from the US together with our team to get that deal done with the benefit of a lot of insight into, in that case, the US market. So 2 things to summarize. One, being focused on a few sectors that we know very well means we can look at businesses we already know in markets we already know, so diligence is made easier. And second, when you have more far-reaching resources within your own organization, you can handle complex situations across geographies, across technical fields, across industries, without having to resort to third parties and outside help, which is made much more complex in the current setup.
But even though you said that you knew those companies before, I guess you hadn't done the leadership due diligence, for instance. You had some contacts with the CEO, for instance. So were you able to conclude a deal without having had face-to-face meetings, without having been able to go to the company? Do you think it's something that is doable with the current context, or you still need to meet and have the physical contact with the firm?
Good question. And in fact, I don't want to speak for Carlyle, but in terms of what we've been doing the last 6 months, we would not have done a deal if we had not been able to meet the CEOs, and we've been able to meet the CEOs. Now, it has been made possible by 3 things. First, we invest in multiple geographies, and not all geography has been affected in the same way at the same time. So we've done a deal in the Czech Republic, which initially in the spring was much less exposed, and we've been able to travel to them quite extensively. We have done a deal in France where after May, we've been able to visit a lot more. So that's the first thing, diversity in terms of geographies. Second is a lot of the deals we've done were in companies we already knew. So we already knew the management teams. We'd met them several times before. So during the course of the deal process, we may only have been able to see them on Zoom, but these were people we knew and we had established a rapport with before. 3, we have people in different places, so the logistics is made easier. And that's true about what we've been doing with businesses that have to do with Asia or in the Czech Republic or in France or in the UK. So I'd say 3 things to summarize. Most deals we've done with companies we already knew. Second, we've been able to invest in places where we've been able to have more physical presence and travel to. And 3, because we have folks in different places, you don't have to travel, but you can have your partner visit companies and you leverage your colleagues. And that goes back to what I was saying earlier. In a context like this, when we have a strong culture and a firm with resources across multiple jurisdictions and multiple skill sets, well, you can mobilize your own teams to make up for the constraint of the pandemic.
That's really, really interesting. Thank you very much for this feedback on the due diligence. One last question, Vladimir. In the coming months, as the M&A market moves again, what will be the greatest opportunities for you and Carlyle in general?
Well, firstly, I hope it's an opportunity to exit and create value for our investors. I think if I speak specifically to my fund, it's a period where we want to focus a lot on add-ons for the portfolio. I think we've done a lot of investment in the last year and in the year prior. And now is quite a good time in the context of high valuations to go create value through consolidation in the sectors in which we have platform companies. So a lot of focus on adding on to our portfolio companies in terms of M&A activity. In terms of new deals, I'd say that what we've done in the last 6 to 12 months is representative of what we want to continue to do. We want to make investments in situations where we can unlock value, ideally primary deals, but where the transaction is leading to new value creation potential. Corporate carve-out, a tech private, a founder-owned business that shifts gear with a private equity sponsor. Number one. And number two, we want to do that in sectors and in transaction contexts where we can leverage our strengths. So industries we know very well, where we have existing investments and relationships, and situations that span multiple geographies, that have a degree of complexity from an execution standpoint, where the fact that we have colleagues across different offices with lots of experience and relationships and contacts can be leveraged to A, deliver a deal, and second, deliver value.
Thank you very much, Vladimir, for those very interesting insights. And when I hear you talking about new value creation potential, I think it's a very promising way to conclude our conversation. I would like to, I hope we will welcome you again soon on our podcast series. And it was a pleasure talking to you today. Thank you, Vladimir.
That was mine. Thank you very much. Thank you.
You've been listening to Capital Call, Boyden's podcast series of conversations with private equity and venture capital executives. To learn more about Boyden's private equity and venture capital practice group, visit www.boyden.com.